As I said before, your article kind of looked at the vastly different kind of valuations that potential buyers put on a business. So let's kind of dig into that a little more. What causes valuations to be so different from potential buyer to potential buyer? I mean, what drives the different perspectives on the value of a business?
Yeah, at the end of the day, anybody that's sophisticated can look at the same data points and derive where they see valuation from a mathematical perspective. What is a business worth? Ultimately, it's worth what somebody is willing to pay for it. And there are two buckets of buyers, strategics and financials. For strategics, there are two primary drivers, fear and greed. Does a deal expand product opportunities? Does it expand geographic opportunities? Does it access new customers or entrench you deeper with your existing customers? How important is this diversification? How substantial are cross-selling and cost synergy opportunities? Does a deal remove a competitor? A lot of times the defensive fear aspect is a high motivator for strategic buyers. How much risk is there to integration? Does a buyer need the management team, or do they have folks that can run the business without them? These are significant questions that impact how a buyer on the strategic side values a business. Their perspectives on this have a huge impact as to where they ultimately come in with valuation. But there's still another factor of timing. It can be a fantastic transaction for a company. It can fit all of the strategic objectives that they have. If the timing is wrong, if the seller is willing to sell when the buyer is not able to buy because they're busy with another transaction, because they have their own issues internally that they're working with, or because it may be a public company and their valuation is simply down for reasons outside of the transaction that we're contemplating here on the sell side, that can impact value. And what somebody looks at value in one situation at a different point in time, they may feel differently about it. So from a strategic buyer perspective, those are really critical aspects that impact valuation and how people perceive the value of a business. From a private equity perspective, it's a little bit different. They really have to ask themselves, how do they feel about the management team? Is it backable? Ultimately, a private equity group is backing a business to operate on a standalone basis. They need the management team to continue to drive that business. Is the business a growth platform? Do they see opportunities to grow organically and through acquisitions? Does the private equity group like the end market? Do they feel strongly about the end market's growth opportunities? What are the downside risks? This is a big one for private equity. When you're a private equity business, you need to have leverage to buy a business. You need to get money, debt from the banks to buy a business. Downside risk is important to the banks. So that impacts what you can pay for a business because you're dependent upon leverage. All of those factors come into play, and I would say particularly on the strategic side, there's a higher beta on those issues because you can have a higher beta on the importance that anybody places on them. And different strategic buyers are going to have different degrees to which a target's going to benefit them. On the private equity side, I think to the extent that people line up, you do get more consensus around value because ultimately the debt markets are going to dictate how much a business can get from a leverage perspective, and that will be an anchoring factor on ultimate valuation that a private equity group can play.
You addressed both the strategic side and the financial buyer side and some of the motivations that affect valuation. So let's bring it all together, and why, I guess, does this matter? What are the implications for someone who wants to sell their business in terms of understanding the motivations of both sides?
Sure. So I think they have very different rationales for doing a deal. As I mentioned before, a strategic buyer will have reasons that may be outside of the actual transaction for wanting to do it. Does it bring them more capability? Are there cross-selling opportunities? Does it entrench them with customers or give them access to new customers? Those are all intangibles that you can't mathematically weigh. You can make assessments, but there are what does it mean to us to not have a certain competitor in a market or to increase a relationship with a competitor? They can be quantified to a degree, but not to the fullest extent. So I think with a strategic, you have both the sides of that equation I mentioned, fear and greed. With a financial buyer, A private equity group ultimately is making an investment in a business to make a return on that business. They want to grow the business, and they want to make money for themselves, and they want to make money for the management team. They need to look at a business on a standalone basis, absent all of those other things that a strategic buyer can bring to the party. They don't have the fear component. They're not already in the space. They're looking for a team they can back to grow and create value. They are looking for a platform. And as I mentioned, they require leverage to do a deal. As part of that, the fact that private equity groups don't have stables of management teams that are sitting around to swoop in to run a business, they're backing a management team. They're going to want to make sure that that management team has skin in the game post-transaction, that there's an alignment of interest. So I think that the considerations for somebody selling a business, one, it allows you to partner with somebody who can bring in some growth capital to grow your business going forward on a standalone basis, but they're going to want you to keep some money in there. They're not going to want you, in most cases, or your senior management team, if you're an owner that's not active in the business, to walk away from that business. They're backing somebody, and they're going to want to make sure that that team is around.
So you mentioned platforms and how private equity firms or financial buyers, they are looking for platforms, and we know that platforms are generally valued higher than add-on acquisitions. So could you tell me kind of what qualities would define a platform business?
Sure. A platform business is really a first entrance into a space or into a market. It's the business that a private equity group looks to back and says, this is going to be the platform that I use to grow within this industry. There are threshold questions that a private equity group needs to answer when trying to enter in an industry and buy a platform. When you're gaining entrance to something, you're typically willing to pay a premium to gain entrance. And then once you're in it, you've got opportunities. You can always weigh, do I try to grow organically, or do I try to grow through acquisition and add-on acquisition? Hence, a private equity group really needs to back a team. When they make a platform investment, that's typically the largest deal that they're going to do. That's going to be the sophisticated team that they back to go out and buy smaller businesses to add on to that company. Once you have a platform, doing add-ons is something that typically creates a lot of equity value for the private equity groups and for the management team at the platform. There are synergies that can be created. You're effectively a strategic buyer in that case, backed with the financial wherewithal of a private equity group. When you go out and do add-on acquisitions, they're typically smaller. In all other things being equal, larger businesses tend to have higher valuations than smaller businesses because there's more cushion, there's less risk. In a smaller business, if you have a customer issue, it simply has a greater impact on the bottom line than if you're a much larger business that has more diversification. But an add-on addition can create substantial synergies. It can create substantial cross-selling opportunities. They can be very complementary. They are, in my view, really a strategic play at that point. Once you have a platform as a private equity group, you become a strategic buyer in the space. And for your platform management team, you're still a private equity sponsor. But for those add-on acquisitions, you really can be thought of as a strategic party that's consolidating in the space with the unique opportunity to potentially give some equity to folks going forward to the extent that they want to roll over equity into the deal on an add-on basis. And gives you the opportunity to choose, at that case, whether you want to stick around or whether you want to sell your business and exit and move on to another phase of your life.